Here are the differences between life insurance and annuity. Life insurance pays out to who? To the beneficiary. When the client, we call him insurer, dies, there is amount of money paid out to the beneficiary. Whereas annuity pays out to the annuitant. It's almost like an insurer in life insurance term. Annuitant is the one that, hey, I'm setting up this plan so that I'll get a income. And normally the payout amount is over your lifetime, or there's, as I said in the beginning, there's a period certain. Let's say you want to make a payment for 10, you want to receive a payment for 10 years, you get payment for 10 years. If you want to get a payment for 20 years, you can set it up so that you'll get 20 payouts. So you get payout over your lifetime. So the difference, life insurance pays when there is a premature death, when death involves. Annuity pays out when the person is alive. So it covers longevity. So life insurance covers premature death. Annuity covers longevity. There are two types of worries. One is dying too soon. If you have people to take care of, like your minor children, and if you pass away, who's going to take care of that minor child? That's why you purchase a life insurance so that at least there will be a money to take care of whoever is left behind. Whereas annuity covers the fear of living too long, or other way to put it is outliving your money. I guess there is not much a thing for living too long. If you're healthy, living too long is not that bad of a deal. But if you outlive your money, and let's say you have $1 million of retirement money and you spend all of it, and if you're still healthy, are you in trouble? Yes, you are. You are in trouble because you outlived your money. If you're breathing, that means there's going to be a cost. That means you need money. Where are you going to get that money? So annuity addressed that very issue of outliving your money. And life insurance provides income. Life insurance provides income for the surviving family members. So there can be a lump sum. You can set up a life insurance so that instead of getting a lump sum, they can get a installment payment too, right? So life insurance pays out whoever is left behind, whereas annuity pays income to the client. And you can set that up. Annuity is the only financial product that provides guaranteed lifetime income. Name any financial product that can give you guaranteed lifetime income. Can stock investment give you lifetime income? No, it cannot. Can 401k give you lifetime income? It cannot. They give you income, but they cannot guarantee that income will last lifetime. So in order for you to have that guaranteed lifetime income, you need to have annuity. Annuity is only one product that actually guarantees income for your lifetime. Or if you want to, you can do 20 years certain. That means you are guaranteed to receive annuity payments for 20 years. Okay? And life insurance, there are term insurance and whole life insurance. Whole life the very term whole life is used very loosely here. I guess what they meant by whole life, they mean cash value life or permanent life insurance. Whole life, universal life, guarantee universal life, IUL, VUL, those falls into whole life category. Whereas annuity, there are I mean, I'm going to talk about different types of annuity, but one way to differentiate the characterize your annuity is whether it is a deferred annuity or immediate annuity. Okay, so that's why life insurance company, it's almost like a playing a roulette. What is the color of roulette? Is it white, black and white? Is it?
No.
Or was it black and red? I don't remember. I haven't played roulette
It's
for longest time. Let's call it a black and white. They play both of the odd. They play dying too soon, and they also play out of living too long. So life insurance company has both life insurance and annuity. Okay. Very first way to categorize annuity is either it is immediate annuity or deferred annuity. Immediate annuity is where you give life insurance company big sum of money, lump sum of money, and life insurance company takes that money and gives you guarantee paid out. So they can guarantee payments of lifetime. They can guarantee you payment of 20 years, 30 years, 15 years, depending on the contract. It's called immediate annuity. You give out you let the insurance company have your money, and then insurance company turn around and start giving you payments from that lump sum. What about deferred annuity? Deferred annuity is normally set up by younger people who's saying that, hey, I'm not in a need of payment right now, but I'm going to save up. And later on, I'm going to start taking money from this account. So it could be 2 years, it could be 5 years, it could be 20 years. A lot of times, deferred annuity do not have a term. You do not need to get an income from annuity in a certain term. It is your decision. You put it in, and 1 year later, you can start receiving money. Or you can put the money in there for 20 years and start receiving money. So there's immediate annuity where annuity payment starts right away, and there's deferred annuity. The annuity payment is deferred, and it will be decided later on by the annuitant, the owner of the policy. Okay. Now here's different. This is a different way of categorizing your annuity. This is by the slide before. It actually breaks the categorize annuity by when does a payment start. Now this one, it categorizes annuity by way they invest your money. Very first one is called fixed annuity. Fixed annuity means easiest way to think of fixed annuity is a fixed annuity is like a savings account in the bank. Or a fixed annuity is like a CD in the bank. If you go to a bank, open up a savings account, do they tell you what the interest rate will be? Yes, they
yeah.
will tell you interest rate right away. For how long? Normally that interest rate is about good for 6 months, 1 year. And what happened to after 1 year? It'll have different interest rate. Let's say you open up a CD, 6 month CD. Your interest rate is guaranteed for how long? 6 months. If you want a better interest rate, you probably open up 2 year CD. If it is a 2 year CD, the CD will mature in 2 years. What about the interest rate? The interest rate is guaranteed for 2 years. What happens after 2 years? The insurance company will redeclare the new interest rate at the end of the 2 years. Same way with fixed annuity. Normally, fixed annuity, the most popular form of fixed annuity is a 1-year fixed annuity. So life insurance company declares what interest rate they're going to pay you over the next 12 months. So if you bring your money in today, let's say you look at their rate sheet, we're going to look at the rate sheet later, and it's just like a mortgage. The rate sheet changes every now and then. Remember when you purchase a house, there's a mortgage rate sheet, so it changes every day? Same thing with a fixed annuity. Same thing with CD. Same thing with a savings account. But on the very day you go in and put your money in, that's the interest rate that you're going to get. And that interest rate is good for 1 year. The money that you put in today, well, let's say it is a 2%. 2% is guaranteed for 1 year. And the next year, around this time, you'll know the new interest rate by looking at their rate sheet again. So it is just like a bank. The interest rate is declared before you put the money in. So you look at the interest rate and you put the money in. That's fixed annuity for you. Okay? What if you want longer than 1 year of interest rate? Can we get that? Yes, you can get that with a fixed annuity too. Let's say you're planning on saving money. You're planning on leaving your money for more than 3 years, and you want to have, you want to know exactly what interest rate you're gonna get in the next 3 years. Then you can have 3-year fixed annuity. That means interest rate is guaranteed for 3 years. So that's fixed annuity. Who's determining interest rate? Life insurance company. And life insurance company determines fixed interest rate depending on their investment return expectation from their general accounts. So if insurance companies guarantee in your interest rate, is that interest rate going to be higher than other form of investment or lower? Probably lower. More guarantee means less rewards. Now, here's something for you to think about. Which one normally has higher interest rate? Fixed annuity from life insurance company or savings or CD from the bank? Which one has a higher interest rate?
Fixed annuity.
Life insurance will give you higher interest rate because number one, they have less overhead. They don't have a branch everywhere. Whereas a bank, they have a branch everywhere. Whenever there's a branch, you need to fill it up with the personnel and things. I mean, it's a lot more complicated than that. But you can. That's one way that I picture it. So normally, life insurance has higher interest rate than CD, even in the fixed account. And here's another thing. When you put the money in CD or savings account, and after 1 year pass, after December 31st, what are you getting from the bank? The bank will issue 1099 INT, which means whatever the interest that you have gained over that year, the bank would report that to IRS, and they'll also send you the same form to you, so that you have to pay tax on the interest. What about life insurance company? Do they send 1099 to fixed annuity? No, they do not. So which means you do not pay tax on the interest, unlike CD or savings account. And this is true with any type of annuity. Then when do you pay tax? The annuity, you pay tax when you take the money out. Only on the amount that you're taking out. Let's say you put $100,000 in annuity and you didn't take any money out. That $100,000 is now has grown to, let's say, $120,000. So you have gain of of $20,000. Until when that 100,000 reaches $120,000, how much tax did you pay for that $20,000 growth? Zero. Unlike the bank. What if you take out $5,000 from that annuity account? Then life insurance company will send out 1099-R to you with $5,000 written on it. So you need to pay tax on $5,000, not $20,000. So it is a lot more controllable. So you only pay tax on the amount that you're spending. Excuse me. Now, what if you take out $30,000 from our example? $100,000 is now $120,000, and you have taken out $30,000. So your taxable income is only $20,000. Why? That remaining $10,000 is actually from your original investment. Unless it is tax qualified fund, which we're going to talk about later. Normally that $100,000, that initial investment is after tax money. So that the IRS is bad, but they're not bad enough to double tax your money. At least on this example. Because that in our example, $100,000 being 120, and you're withdrawing $30,000, so $20,000 is coming from your interest gain, so which means it is taxable, but $10,000 is from your original investment, so that $10,000 is not taxable. Are we all clear on the taxation of annuity? Okay, yes. So that's fixed annuity, and that taxation is true not only with the fixed annuity, but it is also true with the index annuity, and it is also true with the variable annuity. Now, I'm going to skip index annuity for now and move on to variable annuity. Variable annuity is where you put your money not in the insurance company, but you put your money in professional fund manager. No, more than 99.99% of the time, the fund manager is normally picked by insurance companies since it's an annuity. Now this professional fund manager manages your money for you, investing it in stock, bond, money market. They invest it in a foreign market. I mean, depending on investment objectives, they invest your money in different places. Now, since it is an investment, you have a potential of gaining a lot more return on your investment. However, there is also chance that you may lose your investment. You may lose some of your, or part of your, or all of your money. A lot of times you're not losing all of your money in this professional fund management setting. But if you do that, if you get a loss, is there any protection against the loss? There is no protection. So as an investor, you take the risk. If the investment returns positive and high rate of return, you gain that. You gain the most of that. So you have a highest potential of growth. But at the same time, if investment was done poorly or the market is really bad, and if your investment advisor has lost money, then you have to take that risk also. That loss is coming to your account. So that $100,000 you put in can become $80,000, can become $70,000, can become $150,000. And it all depends on investment result. So people are saying that, hey, it's got high rate of return potential, it's high growth potential, but I don't like it. If you don't like it, then you go to index annuity. By the way, the variable annuity, in order for you to sell variable annuity to your client, you need an additional license. It's called Series 6 or Series 7. That's a totally different licensing. It's about managing investment portfolio. So unless you have that, you cannot even sell it. Okay. Now, when it comes to index annuity, all you need is a life insurance license, just like fixed annuity. The difference on index annuity is that instead of insurance company declaring the interest rate up front, fixed annuity, you know what interest rate you're getting ahead of time. But index annuity, you don't know what interest rate you're going to get ahead of time. Why? Because life insurance company put their money, something called option. I'm not going to go over explain what option is, but here's the easiest way to look at it. What you're doing is that your contribution to index annuity is, let's say, S&P 500. Is tied to S&P 500. It does not have to be S&P 500. It could be any stock index. Now, most popular one is S&P 500 index. So if your money is tied to S&P 500 index, and let's say your segment is 1 year, just like fixed annuity, the interest rate is calculated for 12 months, then what they will do is that they check the index today, and they'll check the S&P 500 index 12 months from now on, from today, and the changing the index is a positive. Let's say index went up 10%, then you get part of that 10% in your annuity return. If index went down, let's say the S&P 500 1 year from now went down 20%, then life insurance company will give you return of 0, which means you're not losing any of your money. Index annuity, we call it 0 is your hero. Worst you can do is 0%. The minimum guarantee interest rate. There's a minimum guarantee interest rate. Fixed annuity also has a minimum guarantee interest rate also. But index annuity, a lot of times minimum guarantee interest rate is 0. I've seen sometimes 1, sometimes it's a -1. I even seen some of them has a -2 also. But your rate of return can go anything below that minimum. And most popular one is 0, so you will not lose any money. But if index goes up, you get the part of that index gain. Let's say index went up 10% 12 months from now, and the interest rate will be calculated at the end of the 12 months. And let's say your cap was 9%, then you get 9% instead of 10%. Let's say your cap was 5%, you get 5%. And let's say the instead of cap, the insurance company decide to go with a participation. Let's say you have a 70% participation and index went up 10%, you get 7%. Okay, it's a little bit complicated, but hang on. I mean, sooner or later you'll get it. Okay, so index annuity, you'll know the cap, you'll know the participation up front, but you will not know exactly what you're going to get because you will not know the index value 12 months from now on. Whereas a fixed annuity, insurance company declares that interest rate, so you know going in, as you're going in, you know what interest rate you're going to get. Okay? So we got fixed annuity tied into insurance company's interest rate, index annuity tied into the whatever the index that annuity account is tied to, and the positive growth of the index come back to you with a positive return. Negative growth of the index normally doesn't affect you. It doesn't make your money grow higher, but it does not make your money go lower either. And not only that, good thing about the 0% guarantee is that whatever you have gained before stays within your company, because worst you can do is a zero. Here's what I mean. Let's say you got 7% today, and next year the index went down to 20%, but you get zero. So 7% that you have gained today is still retained within your annuity accounts. All right? Oh man, this is almost like a college course. We got so many terminology. So, refreshing your memory, we talked about immediate annuity and deferred annuity. We talked about fixed annuity, indexed annuity, and variable annuities. So, those are when do you start getting annuity payments, or how your money is being invested. Now, how much money can you put in? What is the contribution? Very first one is called FPDA, flexible premium deferred annuity. Now we already covered deferred annuity. So this means annuity payment will come after at least 12 months. It could be 10 years, 20 years, and it is all depending on the client. What about flexible premium? That means you can dump in your contribution more than once. You can open up an IRA this year, and next year you can dump in more payment into this flexible premium deferred annuity. Okay? Now, single premium, let's go to the next one. Single premium deferred annuity means you can only open up an annuity with one single premium. What if you have an additional premium? Then you open up another account. You cannot you cannot dump in more payment into single premium, but you can open up more than one annuity, so you can open up another single premium deferred annuity or a flexible premium deferred annuity. Why do we even bother with a single premium deferred annuity? Because a lot of time, single premium deferred annuity is a lot more controlled by in the side of insurance company. So a lot of times, single premium deferred annuity insurance company tend to give you higher interest rate than flexible premium. Okay, normally flexible premium is a younger people who are consistently contributing. Normally single premium is for little more mature clients who want to have money grow a little faster with a higher rate of return. Now, single premium immediate annuity, right? SPIA, single premium immediate annuity. So you can put money only once, but you start getting annuity right away. Annuity payment pays out right away. Can you do the flexible premium immediate annuity? No, you cannot. I mean, by default, it can't be done. You're taking annuity payment, you want to dump in more payment into this annuity? It doesn't make sense. All right? TSA, they talk about TSA, but it is not truly a TSA. I don't want to talk about TSA, but I want to talk about qualified annuity, meaning annuities, annuities or 401k. Those are the money, annuities that you can open up with, IRA you can open up with annuity. Then if you do that, not only the interest rate, the interest gain is tax deferred, but your contribution is tax deductible. If you roll over your 401k into an annuity, it's a qualified plan. It's a tax shelter annuity. I don't want to call it a tax shelter annuity. It's a qualified annuity, meaning that even your contribution is is pre-tax dollar. So all your money, 100% of your account value is taxable when you take the money out. But you get the tax benefit of getting deduction on the contribution. All right, that kind of ends my presentation. So I'm going to open up for question.